Hello guys, uh, we are trading a crypto and this is a trend line, pure trend line trading strategy. Let me first talk about how I entered the trade. You see we have here the first touch point, the second touch point, and here I have put a limit order which has been triggered right now. Let me show you the touch points here where I have them. This was my first touch point here, and this is the second touch point here. So guys, what I consider as a touch point, I consider a touch point after seeing at least 2% reaction from my touch point. That's what I consider a touch point. And if I see 2% reaction from the touch point, then I consider it a touch point. Otherwise I don't consider it a touch point until I have a 2% reaction from my touch point. So I have put on a trade and I never risk more than 1%. I can show you the risk reward ratio that I'm having here. If I take the position, let me show you the risk reward ratio here. It is like this. I am targeting, I'm risking here 1% now, and I'm targeting to get 4%. To mean this is to risk $1 to get $4. With this risk reward ratio, guys, I don't need to have even a 50% win rate in my methodology, because for example, if I have even a 20% win rate, to mean 20, if I take 100 trades, 20 trades are going to be winners, and the other 80 are going to be losers. Or let me take, if my methodology is going to give me 30% win rate, to mean 30 trades among 100 trades are going to be winners, and 70 are going to be losers. So if you take 70, I will lose $70. But if take 30 times the 4, I'm going to get $120. So there is a difference of $50 in profit. This is the risk reward ratio. With a risk reward ratio, you don't have to have a higher win rate when you have a large risk reward ratio. And as a matter of the fact, back in the 80s, one of the famous traders, Richard Dennis, he had a methodology where 95% of his trades were losers. 95%. But the 5% which were the winners were the masters, and he was able to make about $400 million in his times. So having a good risk reward ratio is really beneficial. Then what I'm going to talk here regarding psychology is a statement which is familiar in all traders, that is called cut your losses short and let your profit learn. So to cut your losses short, this means when I have put a stop here, and when the market is trending against me, against my direction, then I will take the loss and move on to the next trade. So this is how you have to work. You determine the risk, the trade either works or doesn't, you move on to the next trade. You determine the risk, the trade that works or doesn't, you move on to the next trade. That's the whole game. Because whenever you're in the market, you don't know whether it's going to be a winner or a loser. I tell you again, guys, there is no trading methodology that is based on mathematics or technical patterns that can guarantee you that this trade is going to be a winner. You can believe it to be a winner, and it turns out to be a winner, and your mind associate with the winning and the reason you thought was for it to be a winner, which is a functional belief, and does cause a lot of problems. So because we actually as traders trading other people's perceptions of what is the highs and the lows. The only way for me to win here is when other people who thinks this price is low, then they buy. They are going to buy to the worst price than I bought. But if there are people who are going to slam this rally, for example, and move it down, I'm going to lose. I'm going to take out. Is there any way for me to know whether they are going to come some... do I know whether there are people who are going to come and slam this rally down? Is there any way to know if there are people who believe that the price is high, then they are going to sell? There's no way to know. I can see the collective mind of the market, but the people who are going to step into the market, I don't know. That's why whenever you put on a trade, being on 1 minute time frame, being on 5 minute time frame, being on 1 hour time frame, being on 1 day time frame, or whatever, according to technical methodology, whenever you put on a trade, you get pure random outcome. That's all. So the sooner you believe that whatever outcome of any pattern is random, the sooner you get consistent results. But if you don't, you will see the further and the further you are going far from consistent results. So thank you. Let us stay consistent in our trading methodology and think in an appropriate way, so that our mind is in perfect alignment with the way the market naturally exists. Thanks.